studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
Let's now look at a practical example using the new two-pool refundable tax system. Suppose a corporation earns two different types of investment income during the year. First, it earns $10,000 of interest income. Second, it receives $10,000 of dividend income from another corporation. Both amounts belong to the same corporation, and both will be reported on the same T2 corporate income tax return. From the tax preparer's perspective, the process begins very simply. The interest income is entered into the appropriate section of the tax software. The dividend income is entered into its own section. Once both amounts have been entered, the tax preparer simply instructs the software to calculate the corporate tax return. At this point, something very important happens behind the scenes. Although both amounts were entered into the same tax return, the software does not treat them the same way. Instead, it recognizes that interest income and dividend income are governed by different provisions of the Income Tax Act. The software automatically identifies the type of each income item and applies the correct corporate tax rules to each one. This is one of the greatest strengths of professional tax software. The tax preparer doesn't manually separate the calculations or decide which legislative provisions apply. Instead, the software analyzes each type of income independently and processes it according to its own tax rules. Think of it like sorting mail. Two envelopes arrive at the same mailbox, but each has a different destination. Even though they enter the same system together, they are sorted and delivered along different routes. The same idea applies here. Both income amounts enter the same corporate tax return. However, once inside the software, each follows its own processing path based on the type of income involved. At this stage, you don't need to worry about which refundable tax account receives which amount. The important concept is understanding that different investment income types do not necessarily follow the same tax path, even though they appear on the same corporate tax return. In the next slide, we'll follow those two paths separately. You'll see how the software processes the interest income under one set of rules, the dividend income under another, and then automatically assigns any refundable tax to the appropriate ERDTOH or NERDTOH account. The key takeaway from this slide is simple. The tax preparer enters both income types into the same corporate tax return, but the software determines how each one is taxed. Understanding this distinction is the foundation for understanding how the modern two-pool refundable tax system operates in professional tax software. Now let's follow what happens after both income amounts have been entered into the tax software. In our example, the corporation has $10,000 of interest income and $10,000 of dividend income. Although both amounts are entered into the same corporate tax return, the software immediately recognizes that they cannot be processed the same way. Instead, it separates them into two different tax calculation paths. Let's begin with the interest income. The software applies the corporate tax rules that specifically apply to interest income. It calculates the corporate tax on that income and then determines the refundable portion of the tax. Under the modern refundable tax system, that refundable portion is generally recorded in the corporation's non-eligible refundable dividend tax on hand, or NERDTOH, account. Now let's look at the dividend income. The software recognizes that this is corporate dividend income rather than interest income, depending on the nature of the dividend and the applicable tax rules. The software determines whether Part 4 tax applies. If refundable tax is created, the software then automatically assigns that amount to the appropriate refundable tax account. Depending on the circumstances, the refundable tax may be added to the ERDTOH account, the NERDTOH account, or another appropriate refundable tax balance according to the legislative rules. The important point is that the software makes this determination automatically. As a tax preparer, you don't manually decide where the refundable tax belongs. Instead, your responsibility is to understand why different income types follow different processing paths, and to review the software's results to ensure they are reasonable. Think of the software as a traffic controller. Two vehicles enter the same intersection. One is directed down the interest income route. The other is directed down the dividend income route. Each follows its own rules and eventually reaches the correct destination. The same principle applies to corporate tax software. Different types of investment income may generate refundable tax, but they do not necessarily flow into the same refundable tax account. The software evaluates each type of income independently and assigns the resulting refundable tax to the appropriate pool under the current tax rules. This is exactly why the introduction of ERDTOH and NERDTOH made the corporate tax system more sophisticated. The software is no longer tracking a single refundable tax account. It is tracking multiple refundable tax pools simultaneously and assigning amounts to the correct account automatically. The key takeaway from this slide is simple. Interest income and dividend income may both generate refundable tax, but they follow different tax processing paths. Professional tax software automatically applies the correct tax rules and records the refundable tax in the appropriate refundable tax account, allowing tax preparers to review accurate results without performing the complex calculations manually. Let's bring everything together by reviewing the final results produced by the tax software under Canada's modern two-pool refundable tax system. In our example, the corporation earned $10,000 of interest income and $10,000 of dividend income during the year. Both amounts were entered into the same corporate tax return. But as we've already seen, they follow different tax processing paths inside the software. After applying the appropriate tax rules, the software produces a complete summary of the corporation's tax position. The first result is the corporation's total corporate tax. This represents the overall tax calculated on the corporation's investment income after applying the relevant provisions of the Income Tax Act. Next, the software identifies the refundable tax created during the year. Rather than placing all refundable tax into a single account, the software automatically determines which amounts belong in NERDTOH and which belong in ERDTOH, based on the nature of the income and the applicable tax rules. As a result, the corporation may now have balances in both refundable tax pools. These balances are maintained separately because each may be recovered under different dividend planning circumstances. The software also calculates the corporation's after-tax income. This represents the amount remaining after corporate taxes have been taken into account. The corporation can choose to retain these funds for future investment or eventually distribute them to shareholders as dividends. At this point, the tax calculations for the current year are complete, but an important planning opportunity remains. The corporation must decide how future dividends should be paid. Should it pay eligible dividends, or should it pay non-eligible dividends? That decision becomes important because it affects which refundable tax pool may be accessed and how refundable tax may be recovered in future years. This is why reviewing the software output is more than simply checking numbers. As a tax preparer, you should carefully review several items before finalizing the return. Confirm that the software correctly identified each type of investment income. Review both the ERDTOH and NERDTOH balances. Verify that the refundable tax has been allocated appropriately. And finally, understand how those balances may influence future dividend planning and future dividend refunds. Professional tax software performs these calculations automatically. but understanding the results allows you to explain them confidently to clients and recognize when further tax planning opportunities may exist. The key takeaway from this slide is simple. Under Canada's modern corporate tax system, tax software automatically separates refundable tax into the appropriate ERDTOH and NERDTOH accounts. By understanding how different types of investment income flow into these two refundable tax pools, tax preparers can review software results with confidence and make informed dividend planning decisions that support both compliance and effective tax planning.